What if your biggest investing mistake was one you didn't even know you were making? Warren Buffett, one of the most successful investors of all time, has spent decades mastering the stock market. Yet, he warns that most investors, beginners and experts alike, keep falling into the same traps. In this video, we'll break down the 12 most common mistakes that can destroy your portfolio and, more importantly, how to avoid them. Number 1. Timing the market. Trying to predict the stock market is like trying to predict the weather months in advance. It's impossible. Warren Buffett says the smartest investors don't waste time guessing where the market is heading. Instead, they focus on finding great companies at fair prices. Imagine you found an amazing stock, but then inflation, war, or interest rate hikes made the market crash. It's frustrating, right? That's why Buffett ignores market predictions. He believes in buying strong businesses that can survive any storm. Instead of trying to buy at the lowest price and sell at the highest, focus on investing in solid companies and holding them for the long run. Number 2. Getting emotionally attached to your purchase price. Let's say you bought a stock at $50. If it drops to $30, you might panic. If it rises to $80, you feel like a genius. But here's the truth. The stock doesn't care what price you bought it at. Buffett warns that many investors refuse to sell at a loss because they're waiting to break even. Others sell too soon just to lock in small profits. Both are emotional decisions that can hurt your investments. Instead, ask yourself, if I had no history with this stock, would I buy it today? If the answer is no, it may be time to move on. Number 3. Overestimating growth projections. Companies love to promise big things. 15% yearly growth, market dominance, or game-changing technology. But Buffett warns that only a small fraction of companies actually achieve massive growth. Many investors fall into the trap of buying overvalued stocks, believing they'll grow into their high prices. But most companies struggle to keep up with those expectations. Buffett's strategy? Look for steady, reliable growth, not hype. He prefers businesses with strong fundamentals that can compound wealth over time, rather than chasing the next big thing. Number 4. Using too much leverage. Leverage means borrowing money to invest, and while it can boost returns, it can also wipe out your portfolio. Buffett has seen many smart investors go broke simply because they took on too much debt. He compares it to Russian roulette. One bad move, and you could lose everything. His advice? Only invest what you can afford to lose. If a stock crashes and you're in debt, you might be forced to sell at the worst possible time. Number 5. Focusing too much on details and missing the big picture. Buffett can analyze a business in minutes because he focuses on 3 things: the future economics of the business, the quality of management, and the price of the stock. Many investors get lost in tiny details, like legal contracts, patents, or short-term trends, while missing the big picture. Buffett believes that if a business is strong in those 3 areas, it's a good investment. So instead of analyzing every small detail, focus on whether a company is profitable, has great leadership, and trades at a fair price. Number 6. Taking on investments that are too complex. Buffett avoids complicated investments and advises others to do the same. Many investors believe that if something is complex, it must be a great opportunity. But that's rarely true. Complex investments often have hidden risks, unclear business models, or financial structures that even experts struggle to understand. For example, derivatives, hedge funds, and exotic financial products might promise high returns, but they often come with significant risks. Buffett prefers simple, transparent businesses that generate consistent profits. His rule: if you can't explain how a company makes money in one sentence, don't invest. Stick to businesses you truly understand, and you'll make fewer costly mistakes. Number 7. Chasing hot stocks and trends. Investors often get excited about the latest trends. cryptocurrency, electric vehicles, or AI stocks, without fully understanding the businesses behind them. Buffett warns against investing in hype-driven stocks, as most end up crashing when excitement fades. He prefers companies with strong financials and proven success rather than chasing the next big thing. Many investors who bought overhyped stocks saw their portfolios wiped out when reality didn't match expectations. Instead of following the crowd, focus on companies with a competitive advantage, solid cash flow, and long-term growth potential. Buffett's strategy is simple: be fearful when others are greedy, and greedy when others are fearful. Number 8. Selling too soon. Many investors sell stocks as soon as they see a small profit. But Buffett believes that great businesses should be held for the long term. If a company continues to grow and generate strong profits, there's no need to sell just because the price has gone up. His famous quote, "Our favorite holding period is forever." Instead of flipping stocks for quick gains, think about how much they could be worth in 10 or 20 years. Number 9. Ignoring the power of dividends. Buffett loves dividend-paying stocks because they provide steady passive income. Many investors overlook dividends, thinking they're only for retirees or conservative portfolios. However, reinvesting dividends can significantly boost long-term wealth through compounding. A company that consistently pays dividends is usually financially stable and has reliable cash flow. This makes them less risky than growth stocks, which rely on price appreciation alone. Buffett's Berkshire Hathaway owns major dividend stocks like Coca-Cola and Apple, proving that dividends are valuable even for billionaires. Instead of only chasing high-growth stocks, consider adding strong dividend-paying companies to your portfolio for steady, long-term returns. Number 10. Overreacting to market news. Stock prices move based on news, economic reports, political events, or corporate scandals. Many investors panic and sell during market downturns, locking in losses. Buffett warns against making emotional decisions based on short-term news cycles. He believes in buying quality stocks and holding them long-term, regardless of market volatility. When others panic, he sees opportunity. For example, during the 2008 financial crisis, he invested billions when others were selling. His strategy? Ignore daily headlines and focus on a company's long-term value. Instead of reacting to every market dip, remember that downturns often present the best buying opportunities. Patience and discipline lead to success. Number 11. Not diversifying enough. Buffett believes in focused investing but warns against putting all your money into one or two stocks. Many investors overcommit to a single company, thinking it will make them rich. But even great businesses face unexpected problems, lawsuits, scandals, or economic downturns. Diversification spreads risk, protecting your portfolio from major losses. However, Buffett also warns against over-diversification. Owning too many stocks can dilute your returns and make it hard to manage your investments effectively. His advice? Invest in a small number of great businesses across different industries. This way, if one stock underperforms, others can balance it out, ensuring steady long-term growth. Number 12. Not investing at all. The biggest mistake? Sitting on the sidelines. Many people fear losing money, so they never start investing. But inflation constantly reduces the value of cash, meaning doing nothing is actually losing money. Buffett stresses that time in the market beats timing the market. Even small, consistent investments can grow into significant wealth over decades. The earlier you start, the better. Waiting for the perfect time to invest often leads to missed opportunities. Instead of hesitating, start with strong companies or index funds and let compounding do the work. The key to success isn't perfect timing, it's patience and consistency. Warren Buffett has spent decades learning from his mistakes, and now you don't have to make the same ones. Avoid trying to time the market, don't get emotional about your investments, and focus on the long-term value of great businesses. If you found this video helpful, don't forget to like and subscribe for more investing tips. Which mistake have you made before? And how did you overcome it? Let us know in the comments. Happy investing!